Good morning, everyone. Once again, thank you for joining. We'll be starting the event in the next 1 minute. So we're waiting for other persons to join the call. All right, it's 3 minutes past 10. Thank you for joining the call. If you can hear me loud and clear, can you drop an emoji in the chat box? All right, thank you very much. It's the Aaron Trustees webinar, and we are so happy to have you join us for this great event today, this morning. Also, I'd like to mention that it's Aaron's 31st anniversary, and we're actually in the celebration mood. And in view of that, let's give ARM some thumbs up for celebrating 31 years. It's been 31 years of greatness, 31 years of excellence, 31 years of serving clients all over the world, most especially the Nigerian market. So it's a pleasure to have you join us today for this great event. So we have renowned experts in the capital markets industry who will be taking us through what you need to know for a successful capital raising. We have here Mrs. Yewande Shembore. She's a partner at Olaniwon Ajayi. And we have Mr. Yusuf Agbolan, is the managing director, ARM Capital Limited. They will be taking us through the topic for today, and we believe that you'll be able to get more insight into what you need to know for a successful capital raising exercise in the capital market in Nigeria. So just a quick summary review of the speaker's profile. I'll start with our guest speaker, Mrs. Yewande Shembore from Olaniwon Ajayi. Mrs. Yewande is a seasoned legal practitioner with over 2 decades of experience in commercial law, specializing in banking, structured and project finance, corporate restructuring, and capital markets. She leads the finance and capital markets practice at Olaniwon Ajayi, where she has played a pivotal role in several landmark transactions across the banking, oil and gas, infrastructure, and capital markets. She's recognized as a leading expert. Yewande is ranked by Chambers and Partners for Banking and Finance, consistently named an IFLR 1000 Women Leader. She was also nominated Individual Dealmaker of the Year 2024 by Dealmakers Africa. She holds a LLB from the University of Lagos and an MSc in Finance and Financial Law from SOAS University of London. Yewande also sits on key capital market committees and the boards of 2 companies. Let's give a thumbs up emoji for Mrs. Yewande Shembore. It's a pleasure to have you with us this morning. Our next speaker is Mr. Yusuf Agbolan. Yusuf Agbolan is the managing director at ARM Capital Limited with over a decade of experience in corporate finance, deal advisory, and banking. Prior to joining ARM, he led major strategic initiatives and capital raises at Dangote Industries, managing a $3 billion loan portfolio and the seed landmark transactions across power, petrochemicals, and infrastructure. Yusuf has structured over $500 billion in financing for government and corporate clients and held key roles at FBN Capital, FCMB Capital Markets, PricewaterhouseCoopers, Sterling Bank. He holds degrees from the University of Lagos and an MSc in financial engineering from the University of Essex. A dynamic and solutions-driven leader, Yusuf is passionate about creating long-term value through innovation in financial structuring. Outside of work, he enjoys traveling, playing billiards, and watching motorsports. He's happily married with 2 children. Can we give a thumbs up for Mr. Yusuf Agbola? Thank you very much. Also, we've come to understand that there are people joining us from different parts of the world. So you can drop, okay, the poll isn't on yet, but you can drop in the comment section where you're listening to us from, whether Lagos, Nigeria, outside of Nigeria. It will be good to know that. Thank you. All right. Okay. Solomon from Abuja. Thank you, Solomon, for joining. Thank you, Rakaz in Lagos, Nigeria. Thank you. Thank you, Francisca. Thank you, Lagos. Okay, so we have many people from Lagos. All right, thank you for joining us today. We are so glad to have you on this call. So to dive right in to the meat of this event, we'll be opening up the floor now for Mr. Yusuf Agbola to take us on the topic, what you need to know for a successful capital raising. Mr. Yusuf Agbola, over to you. Thank you very much. Okay, so just before he joins, I think is trying to connect. So we are after the presentation by the Managing Director AM Capital. We'll be proceeding straight into the panelist session where we'll be taking questions and answers from our seasoned experts on this webinar.
Right. Good morning, everyone. It's a pleasure to be here. Toby, could you please confirm if you can hear and see me?
Yes, we can hear you, but we can't see you yet. All right, I think you can proceed. Got it.
But can you hear me?
Yes, we can hear you loud and clear.
That's fine. I'm sure somehow technology has decided to do its thing. Good morning, everyone. It's a pleasure to be here. Thank you for taking out time to join this session. I will be talking to you about the key, success factors for issuing bonds in the Nigerian capital markets. A few slides, put together just to help guide the conversation. But I'm sure we'll have a lot more fun at the Q&A session. As I'm sure you're aware, bonds are the most common fixed income security in the global financial markets. It offers investors the opportunity to earn set payments with a predetermined payment schedule, right? So ultimately, this would appeal to, different classes of investors from, risk neutral to risk averse to even, high risk or risk loving investors. I think in terms of the local capital markets, you'd find that, there has been myriad of issuances, right from, so we've looked at the last 7 years, for example, and there's been myriad of issuances from the government, from major institutions, including governments, and, corporate institutions, right? We're focusing quite a lot on corporate issuances, primarily, just because just to give a bit of a flavor to a useful input to people on the call who I assume would be members of corporate institutions or even business owners. So typically in the Nigerian capital markets, you have issuances from between 3 to 15 years, and naturally your bonds are instruments that you would issue to meet your medium to long-term capital needs, right? So that theme that we see in the Nigerian capital markets keys into the perfect definition for your bond issuance or for bonds, right? In the Nigerian capital markets, we've seen a lot of public issuances, more of public issuances than private placements. But both alternatives offers corporates the opportunity to tap, investors' funds to achieve their strategic objectives. Why bonds? Bonds would offer relatively cost-efficient avenues for capital raise for businesses, and by that I mean, when you compare to other sources, for example, or other alternatives, for example, bank loans. The bond issuance or a bond issuance offers presents a cost-effective alternative. Ordinarily, because this is similar to, it's a debt security, things around, preservation of ownership interests is also top of mind, because ultimately it has nothing to do with your holdings or your capital, your equity stake in your business or in corporate institution. It offers institutions some tax benefit. And also, depending on how it's issued, it offers flexibility to issuers from, issuances with options, and also flexibility around terms and conditions. In the Nigerian capital markets in the last 7 years, we've seen a lot of peaks and troughs. And again, it's not unusual to see that your bonds or fixed income market essentially moves, with the trends of the macroeconomic trends, right? You'd see that we've seen quite a lot of activities post-COVID, and there's been a bit of a dip, coming into 2023, which is where we started to see quite a lot of activity in the interest rate markets. But 2022 stood out for the bond market because it peaked in terms of value of bonds issued. It peaked at almost 700 billion naira. And that was driven by a major activity by one of the largest corporates in Nigeria, issuing a 300 billion naira issuance, to drive production activities within a key sector in Nigeria. We've kind of highlighted, the activities of the manufacturing space or the manufacturing industry compared to, the global values of issued bonds over the last 7 years. In a nutshell, you would see, that the manufacturing sector contributes or accounts for about 65% of the activities in the corporate bonds markets, which is a very good thing, because ultimately what that says is, manufacturers are essentially tapping the market to drive growth and to, continue to contribute to the productivity of the Nigerian economy. What are the things we've started to see in the bond markets? I think we would get into a lot more detail as we proceed. But in the last 2 years, what we have seen is, given the high interest rate environment, there's been, reduced activities in that market. In 2023, a total of 131 billion was issued. And that rose by about 60 billion, to 2020 in 2024. Again, this is a far cry from activities, just before COVID and post-COVID. But I think ultimately, if you take a step back, you would notice that that's a function of, what we're seeing in the interest rate environment and sort of macroeconomic headwinds that most of this that the Nigerian businesses have been exposed to, which has then forced issuers to issuers and issuing houses to take a lot more constructive approach with structuring bond issuances and tapping into options that allows issuers and corporations to be able to still tap the bond markets. And one of it is, the application of call options, which enables the issuer to essentially call the bond for whatever reason after a period in time before maturity. I think what we then proceed to do on the next slide is to show you the sort of options available, the type of bonds that are available. I think for most people on this call, the word plain vanilla wouldn't be, could be familiar. And that's because that's, the simplest type of bond issuance that there is. It's pretty much, a corporate or an institution or even the government raising money for, general purposes, for example, financing new projects or refinancing existing ones, and affording the issuer the opportunity to raise long-term money from a pool of, from a pool of investors who are, willing to invest in the security. You also have green bonds. This has been on the rise in the last 5 years, given the global push towards, untapping, the benefits for the environment and the climate in general. In this case, these issuances are tied to specific initiatives, projects, and/or programs that ensures that the issuer is able to drive or deliver upsides that haven't really been at the forefront till now for the environment and climate, that offers the environment significant benefits. Like I said, this is gaining popularity across the globe, and I think increasingly so in the Nigerian capital markets. The other option is the social bond and sukuk. On the social bond side, I think ultimately it's tied to what you would call social projects, projects that that essentially, for example, afford social benefits, including examples like basic infrastructure or offering basic services or affordable housing, food security, things that tie to social economic growth. While sukuks are also a type of bonds that could be tapped by corporates and or governments. As a matter of fact, I think for sukuks, you have the federal government also driving the most activity here with well over $1 trillion in outstanding issuances. But it's pretty much an Islamic product, and there are different variants of it, right? But ultimately, you can only source for funds under a sukuk that is tied to Sharia compliant projects. I think if you go to the next slide, please. The next slide offers a bit more insights into. Can you please go to the next slide? It offers a bit more insight into how these bonds can be structured and effectively deployed by corporates as guided by the Securities and Exchange Commission. The three broad baskets, that are available beyond types, now speaking to structures, would be unsecured issuances, asset-backed bond issuances, as well as guaranteed bonds. I think they all have some similarities in the sense that you will require parties like the trustees, the issuing houses, to put the transactions together. But in terms of the specific natures of this of these structures, right? I think if you go from left to right, I think it's you can say it's from plain vanilla or conventional to specific bond types. So on the first leg, you have the unsecured bonds, which could be senior, it could be in terms of ranking, it could be senior, it could be junior, depending on the specific circumstance of the issuer. But for this, you would typically have a situation where the issues bonds to the investors, which is made up of qualified institutional investors as well as individual investors, depending on the SEC's view of the transaction at the time. But essentially, the trust deed brings together, the issuer and the trustee who's acting on behalf of the investors. And the major source of security in this case would be some form of, reserves, debt reserves accounts, where the issuer essentially makes payments to ensure that when those set of predetermined payments are to be made, it would have the requisite liquidity to meet the payments to the investors. On the asset-backed side, there's an additional layer, which is comprises of or involves the issuer backing up that instrument with a physical security, a fixed asset rather, and so ultimately that provides an additional layer of security or comfort, ideally to the investor, which to a certain degree could offer perhaps a competitive pricing. Again, this will be subject to specifics of the transaction at the time. In terms of the unsecured bonds, like I said, this is one of the most popular ways or structures adopted by issuers. And an example would be the 300 billion fixed rate senior unsecured bond issued by Dangote in 2022, which was, I think, yeah, it has to be. It's the single largest issuance by a corporate in Nigeria's in the capital markets history. So that's an example. For example, that's an example of how of a transaction which was structured as an unsecured issuance. For the asset-backed bonds, again, this is one that you don't really find. There are not so many examples in the market, but the Cure essentially tapped the market in 2021 to issue a 3 billion bond issuance under this structure. I think what we're finding to be a more common route to market for issuers is the guaranteed bond, where depending again on the specifics of the transaction, this structure introduces a guarantor that provides some sort of a cover or wrap to the issuer and affords the investors more protection. Right. Ultimately, the question of whether or not this affords the issuer competitive pricing is is a different kettle of fish, right? But ultimately, what this does is, the guarantor provides a guarantee to the issuer, and on the back of this guarantee, the issuer issues a bond, to investors. And the guarantee essentially ensures that interest and principal payments are made when due. I think ultimately you would imagine that going from these unsecured bonds all the way to guaranteed bonds, the complexity and the complexity of the transaction sort of increases as you go from left to right. One example of a guaranteed bond would be the most recent would be the issuance of a fixed rate senior bond by Kronberg, which is a 15-year, actually a 20-year bond issuance for the road construction by a state government, which is wrapped by or guaranteed by InfraCredit. On the next slide, we sort of look a bit at the key considerations. What are the key points that ultimately makes your issuance a success? But the key points that I would think issuers should consider before tapping the market. I think right atop the list is your credit rating. Because ultimately, for you to issue an instrument in the capital markets, a public instrument, you've got to be investment graded, right? You've got to have an investment grade rating. And so depending on what sort of transaction, what sort of project you're looking to fund, you could essentially tap two local rating agencies to carry out a rating and ensure, that this rating is investment grade before you then think of tapping the market. It's a different work stream on its own that gives the issuer an opportunity to even better understand, from an independent standpoint, sort of risks that that investors are likely to price as they consider the issuance as they consider the investment opportunity or the issuance by the corporate. Which then brings me nicely to price determination. Price determination is a function of, think of it as a build-up, right? The investors essentially want compensation for certain risks that they have predetermined based on analysis or even as outlined by the rating agency, right? So ultimately, as an investor, the thinking would be to ensure that the instrument offers significant or adequate compensation for these risks, which could range from, a default risk to liquidity, etc. Right. And so you would see, this build up starting with a reference rate, which would typically be risk free. In our markets, that would be FGM bonds of a similar tenor to the instrument being issued, and then there's a build up from there to accommodate or to compensate for all this the perceived risks of the investment. Coupon payments is also something that corporates need to think about. Ultimately, depending on the specific situation, you would either have to issue bonds and offer floating rates or fixed rate coupons. In our markets, specifically, I think what we have seen is, investors are comfortable with fixed rates. And that ties with the specific definition of your bonds. I think ultimately there's an option to do a floating rate issuance with the rates indexed to certain references or reference rates, which could also be the FGN bond yields. But in terms of what we've seen in the market and the sort of appetite that investors have, issuers have tilted towards to the fixed rate issuances. Another key consideration would be the mode of issuance, right? The regulator, the SEC, affords you the opportunity to register a program, which essentially shelf registration, as it's called, affords you the opportunity as an issuer to maintain your record over a 3-year period and tap the market at any given time, so long as that registration is valid, or come to the market and do a one-time issuance. I think ultimately this would depend on the objectives that the issuer is looking to achieve and the sort of capital raising program, or for example capex program that they need to execute to drive strategic objectives or initiatives within the organization. Again, an important point to consider is principal repayment, so coupon and principal, because ultimately, like I said earlier, and as you know, bonds offers a steady flow of repayments and based on a pre-agreed repayment schedule. And so one of the things that the investors need to know, or you need to think about, and investors will be very keen to know, is what sort of profile are you proposing? So the market has seen bullet repayments as well as amortizing repayments. So on the previous slide, we are giving you examples, but I think all the examples there are essentially bullet repayments, which means payments are made at maturity. I think the last consideration would be the options that are available to you, or how to tap into the flexibility or flexible nature of bond issuances, right? As you know, the interest rate environment has been on the up, and that's been also on the back of a number of factors. So inflation rising, NPR also following suit. The question is, why do I go to the market and issue a fixed rate bond and lock in that rate for X number of years, 3 to 15 years, for example? So what this has then done, what the conditions in the market has then forced issuing houses and issuers to do is to tap into the options available. For example, what we have seen in the market in the last issuances would be, the inclusion of call options, which affords the issuer the opportunity to call the bond, where, for example, you enabling the issuer to tap into upsides where there's a reversal of rates, for example, or conditions within the business seemingly has changed, and so those bonds then become a bit more expensive than the issuer would like. So these are sort of high-level considerations that, if well thought through, could help ensure a successful bond issuance. I think in closing, it's important to touch on the universe of investors, as well as key regulatory conditions or considerations rather. Like I said earlier, you could do a public issuance or a private issuance. There are certain conditions or considerations that the issuer, the corporate or the federal government, needs to have top of mind. As a public issuance or a public issuer, you have access to a broader base of investors, which ultimately increases your probability of success to raise the amount that you set out to, right? Whereas as a private issuance, under a private issuance or a private placement, there's a restriction from a regulatory standpoint around which sort of investors can invest in these securities. Okay, so daily, as you would expect, when you're setting up your issuance and you're bringing together your team of advisors, including, the issuing house, the trustees, just ARM trustees, ARM Capital, and your solicitors, you've got to think about, taking a holistic view of, what sort of objectives you're trying to achieve, what size of issuance, for example, are you looking to do, right? And then these sort of considerations helps to guide whether you do a private placement, or a public issuance, and all within the regulatory guidelines. Okay. In any case, you would need to secure the approvals and no objections of regulatory bodies, primarily the SEC and, potentially FMDQ, where you're looking to list the bond on their platform, or even NGX, right? Like I said earlier, you need to achieve, ratings from, or obtain ratings from 2 public SEC regulated rating agencies, and you also need to ensure that your applications, at the time of application to the SEC, you're not, there's been no event of default, at least in the last 6 months, prior to the time of seeking the SEC's approval. I think even in the last couple of weeks, we've seen, some, amendments to the rules, the SEC rules around bond issuances, which further restricts or puts a bit of hurdles for corporates, issuers looking to issue private placements, right? And even first-time issuers. So I think ultimately you'll be required to, in collaboration with your suite of advisors, to look through the regulations carefully to ensure that, depending on where you are as an issuer, you're able to tap the markets in line with the SEC's guidance. In terms of the ultimate objective, which is to successfully raise capital, right at the top of the universe of investors would be your pension fund administrators, especially where you're issuing public notes, right? In terms of liquidity, in terms of appetite for bond issuances, these entities essentially rank top, as today, based on what we know of the of total assets being managed by PFAs, well over 6 trillion is available for issuances or for investment in bond issuances. Right below would be your insurance companies and your asset managers, who are more amenable to issuances in the medium term, so 3 to 5 years, and ultimately at perhaps much higher yields compared to your pension fund administrators. And right at the bottom would be your local banks. I mean, I think the reason for that isn't far-fetched. By the time you consider their cost of funds, as well as their own risk appetite, I think they essentially fall at the bottom of the pile. But then, of course, you have other type of investors, from financial institutions to high net worth individuals, right, who can also participate in bond issuances. I think I would leave you with this final thoughts, that to successfully issue your bond, you need to identify the right partners, and ensure that these partners are develop a good understanding of your business and are able to guide you appropriately towards unlocking the next wave of growth for your business. And I think it's only right to say that you have a very good mix of those partners across the room, from ARM trustees who have gracefully put this together and brought all of us into the room. They have extensive experience providing trustee services for bond issuances and all that type of transactions, to ARM Capital, who has also garnered over 2 decades of experience in doing this type of transactions. SEC registered, FMDQ approved member who can essentially handhold issuers to achieving a successful capital raise. To the team also at Olaniwa Ajayi, who've done this time and time again. So I think hopefully this sets the scene for the next session, where we'll be fielding and answering your questions. But yeah, I would yield the floor back to the convener. Thank you very much for listening, and I'm happy to discuss further. Toby, over to you.
All right, thank you very much, Yusuf, for that insightful presentation. Let's give Yusuf a round of applause. Let's drop the emojis in the chat box. Thank you, thank you, thank you. Yeah, so right about now, we'll be going to the Q&A segment, where we'll be having our seasoned expert, Mrs. Yewande Sebore from Olaniwa Ajayi LP, and Yusuf Agbolam, and I'll be moderating this session. So Yusuf, can you try to turn on your video again? Let's see if technology will be good to us this time around. Any luck, Yusuf?
I think, unfortunately, no. Technology continues to fail me.
All right. Okay, so we'll proceed right to the Q&A segment. So if you have questions,
I think I'm back
please.
up.
Okay, can you hear me? Okay, it's
Yes.
better. Okay, great, great. All right, Mrs. Sebore.
Yes, and I can hear you loud and clear.
Yes. Okay, could you please turn on your video? Okay, it's on. All right, I think it's the network over here as well. Okay, so we'll proceed right into the Q&A segment. So I think the first question I have here, so if you have questions, please drop it on the Q&A chat box, and we'll pick it up from there and answer your questions. So the first question I have for you, and this will go to Sue, is you mentioned the fact that PFAs, as pension fund administrators, have about 6 trillion naira in terms of investable funds. So as a company, we would like to know, what does a company need to do in order to access this funds, or in order to become, or in order for their bonds to um, they access this funds, be an investable grade bond, right, to access these funds from PFAs. Okay, Yusuf is, oh, okay, so I think, okay, while we're waiting for Yusuf to come back on, so we have a question from Mrs. Simbori here. So the question goes thus, what does a company need to do pre bond issuance and post bond issuance in terms of the legal aspect? So in terms of the legal expectations of a company in issuing bonds, what does the company need to do pre bond issuance and post bond issuance? So what are the legal considerations for this? Over to you, Ms. Mbara.
All right, thank you very much, Toby, and congratulations again to Aaron on your anniversary. Just on that question, I think part of the things that a company needs to do will take off from the presentation that Yusuf made just now. He had spoken about the approach and the methodology for bond raising. So if we take a view that a bond can be issued as a public offering or a private placement, that would then take us to, the question that has been asked. When it's a private placement that's being issued, a private company can issue such a bond, right? But if it is a bond to be issued to the public, that instrument would be issued only by a public company, or as provided under the Investment and Securities Act, a company licensed by the CBN to receive deposits, or a free zone entity. I do note that there had been an amendment by the Business Facilitation Act of the old ISA to allow the SEC make rules in relation to private companies being able to issue securities to the public, and the SEC has, in pursuance of that, gone ahead to make those rules. But interestingly, we do have a gap in the current ISA, which was recently passed into law. And so that still remains an open question as to whether private companies can issue to the public. So taking it back to what the company needs to do, I think the first step will be to identify the methodology through which the issuance will be carried out. So if it's a private company that seeks to approach the market to raise bonds, then you need to determine, if you're going by way of a public offer, you are either having to convert, first of all, to a public company, or establish an SPV that as a public company that will then go into the market for you. Now, all of this conversation will tie back to the structure of the issuance itself, the purpose for which the money is to be raised. And that means you do need to have the right partners, just as Yusuf mentioned. You need to have the right parties around the table guiding the company in terms of what it needs to do. So the first thing you need to do is appointing relevant professional parties. Critical to this would be your issuing house and your lawyers. Now, under the law, you are required to have a solicitor to the offering. Now, you could also have your internal legal team working with you, or a solicitor to the company that are responsible for advising on the nitty-gritty of the process. And what process are we talking about? Critical to an issuance is the corporate and internal approvals that are required to be in place. And this means that the first step, beyond checking whether you're a private company or a public company requiring a company requiring conversion from private to public to access the market, you also need to look at your constitutional documents. By these, I mean the memorandum and articles of association of the company to determine what powers exist and any limitations to the borrowing powers of that company. Once you test that, you can determine whether a shareholder resolution will be required or a board resolution would suffice. Under the new amendments to the SEC rules, the SEC has made it very clear that where there is a limit to the borrowing powers of the company beyond just a board resolution authorizing a bond issuance, you need to accompany that with a shareholders resolution. Now, these things need to be in place early enough because for most companies, it takes time to convene these meetings, and these are prerequisites to even submitting an application to the SEC. Of course, as I said, you would have appointed your professional advisors who are responsible for the documentation. A key part of approaching the capital markets to raise capital for any entity at all are the disclosures that embed raising monies from the public, which is an element of the protection that the regulator provides to investors. And this means that internally, the company needs to identify what are these heads of information that are required to be disclosed. So typically you require your prospectus, and there are heads of information that are required at the basic minimum to be included in that prospectus. So the gathering and the collation of that information is critical. This information can be broadly put into buckets of financial information, corporate information, as well as your risk factors. Now, with the financial information, you're looking at your 3 years audited financial statements, and then you have to have the most recent statement not beyond 9 months old. So if it goes beyond 9 months, then you have to go back and get fresh accounts to be published. Now, all of this needs to be collated and then included as the documents and the information to be disclosed within your documents. There's also an extensive due diligence that needs to be conducted from a legal perspective, because your solicitors have to give an opinion on the company, whether there are liabilities that could threaten the ability of that company to raise capital from the market. And so there's a due diligence exercise to be conducted, pursuant to which material contracts are looked at, as well as your claims and litigation. Now, these claims and litigations are very critical because you are examining the files of the business to ensure that there are no contingent liabilities that could have a material adverse effect on the business or the ability of the business to repay its obligations. Beyond the disclosure, of course, you have the regulatory compliance itself, which is the statutory approvals you require, necessarily filings with the SEC and approvals from the SEC. But more importantly, where the issuer operates within a sector, you also need to have your sector regulator approval for that process. Once the documentation has been put in place, of course, there is the post-compliance requirement of continuing reporting obligations on use of proceeds. Particularly, the SEC is very big on use of proceeds, and they will not permit you to come to the market again. In fact, fines have been applied to issuers who have raised monies and not applied same in the manner that has been disclosed in their prospectus. So use of proceeds and continuous monitoring of same, filings of your financial statements, periodic financial statements will be required. And then if there are any changes to the circumstance of the issuer, you're also required to file this as part of the continuing disclosure obligations to the regulator. Thank you.
All right, thank you very much for that extensive answer. I think that gave us a more thorough insight into what the solicitors to the transaction do with respect to bond issuances. I think Yusuf is back. Yusuf, can you hear us now?
Yes, I can.
Okay.
Yes, I can.
All right, thank you. So we had a question for you. So you talked about the 6 trillion naira that is available within the PFA space. So the question is, how do I make my bond an investment grade and to be able to access this 6 trillion naira?
Okay, thank you very much for the question, Toby. I think the first thing is, you know, the credit rating and the outcome of the credit rating process. Ultimately, to access um, funds from PFAs, um, you have to issue investment grade instruments. So, which means by extension, you have to be an investment grade issuer, right? And so, the first thing is, ensure that the rating of the issuer and the issue, um, is investable. Well, is of investment grade, and by extension, the instruments being issued by the issuer is investable by PFAs. Now, where, for example, the rating outcome suggests that the issuer or the instrument to be issued is not investment grade or is not of investment grade, there are alternatives available to the issuer to drive that rating upwards. And so one of the options that we talked about was the guaranteed bonds, where you can have a guarantor with a significantly higher or a better credit rating, that guarantees the repayments of, interest of principal and payment of interest during the term of the bond issuance. One of such institutions would be InfraCredit. They are a triple A rated institution. And so the wrap of the investor or the guarantee provided, the wrap of this institution or the guarantee provided by such an institution sort of helps to balance out the risk perception from the investors, in this case, the PFAs, right? Because in addition to the the pension funds are guided by, PENCOM, and there are clear rules as to what they can or cannot invest in. So it's clear, first of all, that, you must be a public issuer, right? Two, it must be investment grade. So where you are not by yourself or as an issuer, where the credit rating is not good enough to attract this type of funds, you have to seek out credit enhancement. And one way to do so is, to have an institution with a higher rating provide some sort of cover to you as an issuer, and by extension, the instrument to be issued. So to my mind, that helps, at least gives you one step through the door to tapping, funds to the tune of 6 trillion available for bond issuances.
All right. All right. Thank you very much, Yusuf. So you talked about private issuance and public issuance. So as a company, as an issuer, so I would like to know which exchanges or which markets are available for me to issue, whether it's a private issuance or a public issuance. Where do I list my bonds?
There are two major exchanges, the NGX and FMDQ, where your bonds can be listed. And I think the question for me is, or the more interesting bit of the question is, why do you even list the bonds in the first place, right? Like I said during the presentation, your investors would essentially build up the price of the paper. Well, obviously, you would find a lot of issuances, going through a book build process where essentially in collaboration with the issuing houses, we essentially go to the market and sort of build the book, as the word implies, which involves gauging the interest and appetite of potential investors and, establishing the volume as well as their preferred price points. One of the key considerations for investors, beyond one of the key considerations for investors borders around risks, right? And the perceived risks of the issuance and by extension the issuer, right? And one of the risks that they would assess is liquidity risk, meaning, how long, for example, would it take me to exit this position, to liquidate this investment, to monetize this investment prior to maturity, right? Which then, further explains or amplifies the reason why the exchanges are of importance. Because once you issue the security as an issuer, the fact that you've listed it on the exchange gives birth to a very active secondary market where existing investors can trade these investments, for whatever reasons, right? And so I think that for me is a more salient point, but I think the key exchanges that we have is the NGX, formerly known as the Nigerian Stock Exchange, as well as the FMDQ exchange.
All right. Thank you very much, Yusuf. Mrs. Semborek, so we have a question for you. You talked about the role of solicitors in a capital market issuance, right? Can you please also explain to us the roles trustees and registrars play? Because we typically know that the trustees and registrars stay till the end of the transaction. So can you explain to us the roles they play and the benefits of having them?
All right, thank you. So in terms of trustees, I think one of the things I mentioned earlier was the need to ensure that you have the right professional parties around the table, and one of such is the trustee. In certain jurisdictions, you could have a paying agent rather than a trustee. But in Nigeria, what we have is a trust structure pursuant to which our bond issuances are framed. And so a trustee is an integral part of the bonds transaction in the Nigerian capital market. And the trustee's role is simply to act as the representative of the investors on the table at the point of documentation and going forward. Now, the trustee stands in that stead as their agent, their representative, as the custodian of the rights of the investors, as well as the eyes and ears of the investors, so to speak. And because trustees are regulated strictly under the law, they have the legal responsibility because they're fiduciaries. And so when they hold those rights in trust for the investors. And beyond the rights also, if we remember during the presentation, Yusuf talked about 3 different types of bond issuances: the unsecured, the secured, and the guaranteed. Now, with the unsecured, you're looking at the bond trustee acting as the recipient of the rights under the transaction documentation, as well as the custodian of the payment account, and the pool of funds that will be received and utilized in making payments to investors. Where the bonds are secured, the assets, except you have a separate security trustee, the assets underpinning the instrument that has been issued, the assets by which the instrument has been secured, would also be under the legal purview of the trustee. So the legal rights the same would be held by the trustee in the instance. And also with the guarantee, the benefit of the guarantee would also be in favor of the trustee on behalf of the investor. So the trustees play a very crucial role in protecting and ensuring that they safeguard the interests of the investors. Also, beyond the rights, when there are steps to be taken to enforce the rights of investors, in order to manage the volume and the number of potential investors, the trustee also stands in the stead to act on behalf of the bondholders, of course, pursuant to meetings and rights that would have been conferred on it under the trust deed to enforce the rights of the bondholders. So the trustee's role is both at the point of conception and putting in place the bond documentation and the bond itself, and then going forward for the life of the instrument, the trustees remain a focal point and remains the eyes and ears of the bondholders going forward. The registrars typically act as administrators. They keep the books and they keep the records of holders of the bonds, and so maintain the books in relation to the trades, the sell downs, the redemptions in relation to the instruments themselves. So the registrars also monitor the holders of the bonds and keep the records of the holders, and sometimes also they are responsible for the transmission of the coupons during repayment for the purpose of disseminating same to the bondholders. And these two parties are very critical. Now, oftentimes you may not always see a registrar, but you would always see a trustee within the Nigerian framework of trust-based bond issuance. You would always see a trustee as a critical part of that. And that's also something that can be seen as a modicum of investor protection, because your trustees are guided by regulations. They are compelled to act within the purview of legislation and statutes, and they are also fiduciaries, which means they are required to act in good faith and to separate the assets of the investors away from theirs. So when the trustees act in that stead, the insolvency or bankruptcy of a trustee does not impact its role or the assets it holds for the benefit of the investors. So they are very critical to successful bond issuance and also for the life of the bond itself.
All right, thank you. We'll be rounding up shortly, but we have about two questions. The first question, I think I will share this with Yusuf. So the question says, how is revenue shortfalls associated with falling crude oil price and lower production rates in Nigeria? Vis-a-vis the high cost of funds impact. Vis-a-vis the high cost of funds that impact bond yields. Yusuf, I don't know if you got that question.
It's in the chat box, so maybe I read it as well because it's a bit of a mouthful.
Yes.
So
Yeah, so I think this person is trying to ask how those revenue shortfalls impact bond yields.
Revenue shortfalls on
associated with falling crude oil price. Yes.
Right. So it's on part of the government, right?
Yes.
Okay.
Yes.
Okay. I think on the one hand, there's been a lot of chatter around the outlook, right? For Nigeria as a whole. I think we've seen, for example, IMF coming out with a mixed bag. On the one hand saying GDP would grow, on the other saying, we're somewhat worse off in terms of, food insecurity, naira depreciation, and reduced production output, which, affects our revenue generating potential as a sovereign, right? So the downsides highlighted, does have an adverse impact, right, on the yields. But the truth about it is, so if we take a step back, if, for example, the sovereign's main source of income or of income is, from the sale of crude, and you see the dip in, for example, crude prices or production volumes, what that means is, there's some constraint around your debt serviceability, which could then trickle down to, credit risks or potential, credit risks And that ultimately then, also trickles down into pricing and yields, right, in the secondary market. So these things have a direct, implication. But what's important to note is, when your secondary market is active, right? And first of all, the secondary market is active as the Nigerian, as a sovereign. The secondary market for your issuances, be it FGN bonds, be it your Euro bonds, is those instruments are very active on the secondary market, right? And so the views that you see on a daily basis, to a certain degree, don't, could have initial, it takes, so you find that there are lags, for example, between when you see, the impact on the yields and when the news breaks. So investors will typically take a view, over a period of time, and then you can start to see those views reflect in the yields of the instruments traded, right? So again, if the IMF report came out, for example, 2 weeks ago or a week ago, right? You would expect that you could see some activity in terms of the yields, as it trades on the exchange in the secondary markets. But again, as more often than not, these views or these changes you see are guided by long-term views of investors, backed by their own analyst thinking internally and what have you, right? And so ultimately, my short response would be investors will take a view, and that's not necessarily as the news breaks, especially for fixed income. I mean, if it was equities, for example, it's a different thing entirely, right? And so that's how I would respond to that.
All right. Thank you very much, Yusuf. I think it's 9 minutes past 11. Our intention was to make this event a one-hour event. So now we'd like to appreciate our guests. Please let's give them a round of applause by dropping the clap emojis. Thank you so much for taking our time to speak to us today and share insight on this topic. Let's keep the claps coming in. Thank you. Thank you. Thank you very much. Thank you. So now we'll be handing over to the Managing Director, ARM Trustees Limited, to give the vote of thanks. Thank you, Mrs. Moronke Bangbala. Over to you.
Thank you, Toby. Please confirm you can hear me.
Loud and clear.
Thank you. I think that firstly, I would like to appreciate our speakers, who also happen to be our panelists this morning. Thank you very much, Mrs. Sembore. We appreciate you. I personally had one or two things to take away from what you have told us today, and I hope that our attendees, were also able to take some things away. I would also like to say thank you to our attendees. I like the questions that I hear, and I would say that after now, we would also share some questions and answers that would help all of us, given the time limits that we had to work with. Thank you very much. And to my ARM team, to my fellow colleagues, I say thank you. Thank you, Yusuf, and thank you, Toby, for a job well done. I hope that our attendees are also able to say that to us, but I really enjoyed every bit of it. I would also like to say that as we close, if you want to reach out to us, please do. You can reach out to us on, I think, info@armtrustees.com. info@armtrustees.com. I'm not sure if we have that on the screen, but if you want, just send us an email on info@armtrustees.com. If you want us to take this conversation to another level, we are available on info@armtrustees.com. Thank you very much for spending I think about 70 minutes of your time with us. We appreciate, and we do not take this for granted. I hope and I believe that this 70 minutes was useful and worth your while. Thank you very much again, everyone.
All right. Thank you, everyone. And now we've come to the end of this event. You will get a feedback form in your mailbox for everyone who registered. And also, if you intend to, and also a recap of this event. So also, if you intend to reach us, we'll also be sending emails to you. You can reach us on those feedback forms, and we'll be happy to get back to you and provide support and services to your good selves. Thank you very much. Thank you once again, special guest. Thank you very much, and lovely attendees. Thank you for taking our time to join this call, and we look forward to seeing you at our subsequent webinars. Thank you very much, and have a great rest of the morning. Bye.
Thank you. Bye-bye.